If you're a business owner, tax law changes can feel like background noise until they hit your bank account. And the truth is, most people don't lose money because they didn't know the law. They lose money because they wait too long, make reactive moves, or assume their old strategy still works. Today, I'm going to give you a simple way to think about recent tax law changes so you can spot what matters, ask the right questions, and protect your cash flow. Let's keep this practical. When tax laws change, business owners tend to ask one question: is this good for me or bad for me? But the better question is, what does this change affect? My income, my deductions, my credits, or my timing? Here's the framework I want you to use. 1. Changes that impact your taxable income. Any change that affects how your income is taxed is a big deal. This includes changes that influence what qualifies as business income, how pass-through income is treated, or whether a deduction is limited or phased out as income rises. What to do? Don't wait until tax time. If your income is trending up, you want a mid-year check-in so you can adjust withholding, estimated payments, and strategy before you get surprised. Number 2, there are changes that impact deductions. This is where many owners miss money because deduction rules often change quietly. The most common deduction-related issues are depreciation rules changing over time, limits on what you can write off, and timing differences that affect when you get the benefit. Here's what to do. Ask your CPA, if I invest in equipment, vehicles, software, or improvements this year, what is the real after-tax impact now versus later? Because timing matters. A deduction today is not the same as a deduction spread out over years. 3. Changes that impact credits. Credits are different than deductions. A deduction reduces taxable income, but a credit can reduce your tax bill dollar for dollar, but only if you qualify and document correctly. Credits often come with rules that business owners miss: employee count thresholds, wage requirements, benefit structure requirements, and documentation requirements. What to do? If you've hired, added benefits, improved access, invested in R&D, or changed retirement plans, you should be asking, did we trigger any credits this year? Number 4, changes that impact reporting and compliance. Sometimes the tax law change isn't about saving money, it's about avoiding penalties and cleanup. For example, reporting thresholds shift, forms change, documentation expectations tighten, and states may introduce rules that don't match federal treatment. What to do? Make sure your bookkeeping and reporting are clean enough to support your position, because the best tax strategy in the world won't help you if the records don't back it up. Number 5, the owner's rule. Don't make tax moves in a vacuum, and this is a big one. The most expensive mistakes happen when owners chase tax savings that actually hurt the business. So before you act on any tax change, ask, does this improve cash flow after considering payments and timing? Does it increase complexity that will cost me more money to manage? Does it align with my long-term plan, or am I reacting out of fear? Because smart tax planning is not about tricks, it's about aligning your structure, timing, and documentation with real business goals. Recent tax law changes matter, but what matters more is having a clear process to evaluate them before they hit your cash flow. If this was helpful, please like, subscribe, and comment the word changes if you want a simple checklist of the 5 questions every business owner should ask their CPA when tax rules shift. Thanks for watching, and I'll see you in the next video.